Welcome back to Market Fluency. Thursday, March 19th, 2026, opened with intense geopolitical anxiety following overnight attacks on Middle East energy infrastructure. The morning tape reflected immediate market panic. Brent crude, the primary global price benchmark for oil, briefly spiked to an intraday high of $119 a barrel. This chart shows Brent crude's dramatic intraday spike overlaid against the major indices. As oil receded toward $108 this afternoon, equities absorbed the shock. The S&P 500 slipped just 0.27%, the Dow fell 0.44%, and the tech-heavy Nasdaq edged down 0.28%. The major indices holding those lines proves that investors are not ready to hit the total panic button on the broader market. Instead, the most actionable volatility right now is happening entirely under the hood in specific megacap stocks. Micron Technology, a global leader in memory and storage solutions, delivered a massive earnings beat today. Thanks to red-hot AI hardware demand, their quarterly sales nearly tripled. This candlestick chart shows exactly how Wall Street reacted. Despite the flawless revenue beat, Micron faded a massive pre-market surge, dropping 3.71% on heavy volume to close deeply in the red at $444.59. The sell-off was triggered by management signaling massive capital expenditures, or CapEx, the money a company spends to buy and maintain physical assets. Micron plans to spend a staggering amount exceeding $25 billion to expand production, which instantly spooked profit-taking investors. In the AI infrastructure space, tripling your sales does not guarantee a stock bump if you have to spend tens of billions to do it. The market is shifting from ignoring costs to heavily scrutinizing exactly how much cash these semiconductor companies are burning to build capacity. Over in the social media sector, Meta Platforms slipped 1.46% to close at $606.70. However, that drop was tied to the broader tech pullback, masking a massive internal policy shift. Late today, news broke that Meta is officially shutting down its VR, or virtual reality, Metaverse division. After burning tens of billions of dollars chasing a virtual reality ecosystem, the company is finally pulling the plug, closing the books on one of the most expensive failed corporate experiments in Silicon Valley history. Meta will now reallocate capital entirely towards core AI integration and improving advertising efficiency across Facebook, Instagram, and WhatsApp. Instantly stopping a multi-billion-dollar cash incinerator is a massive win for profitability. Reallocating those funds sets up immediate margin expansion, making Meta highly attractive to growth funds focused on actual free cash flow. In the materials sector, Newmont Corporation, the world's largest gold mining company, tumbled 6.92%. The stock broke down through near-term technical support to close below the psychological $100 mark at $99.17. This comparative line chart reveals the macroeconomic pressure. Following the U.S. Federal Reserve's pause yesterday, the European Central Bank and the Bank of England both held firm on rates today. This globally coordinated high interest rate environment sent bond yields surging and pushed the U.S. dollar higher. That combination crushed bullion prices, sending gold down nearly 6% today, dragging major miners right down with it. Gold pays no dividend. With central banks holding firm and bond yields grinding higher, the opportunity cost of holding precious metals is currently too steep, justifying an underweight position until we see tangible rate cuts. We want to hear from you down in the comments. Is Meta shutting down the metaverse a bullish signal for their stock, or just proof of billions in wasted capital? Let us know, and as always, stay fluent.